All right, so in this chapter, we're going to be looking at long-term operating assets. And in this case, and of course, tomorrow what I'll do is I went through all the homework and didn't spot any errors, but I just want to point out maybe some key points for you. So when we look at long-term operating assets, first let me summarize the categories. We're going to focus on two of these categories predominantly. So we have tangible natural resources, intangible assets. And when we look at intangible assets, we have a couple of categories in here. You have finite life intangibles. You have indefinite. Life intangibles, and then you've got goodwill. Now, when we look at these categories, a finite life intangible, an example would be a franchise. So you buy a franchise, I don't know if you read the chapter, but some of those franchises are pretty expensive. I guess to buy it, it's like, 50 to 100 grand. And I think as part of the requirements, you have to have a reserve cash of 400,000, something like that. So it's pretty expensive, but it gives you the right to sell the product. Indefinite life intangibles would be something like a trademark. Textbook uses the Nike swoosh as an example, or the Apple logo. That is going to last indefinitely. It lasts as long as the life of the company, right? Not going to go anywhere as long as Apple is still in business. So when we look at these assets, each one of them, now remember, we had for expensing, bringing this back to chapter 7, to expense the assets, what did we have? Direct association, cost of goods sold matched exactly with sales, sales commissions matched exactly with sales. We also had immediate recognition, something like research and development, advertising, and we also had systematic allocation. Systematic allocation is going to apply here. So all of these assets, with some exceptions, will lose value. So tangible fixed assets are subject to depreciation. Except land. Now that's in this area, but in farming, land could lose value, I guess, if it's no longer capable of growing crops. Natural resources, subject to depletion, and finite life intangibles. are subject to amortization. Now, indefinite life intangibles and goodwill are not amortized. And all categories all of them are subject to impairment, would have an impairment loss. So in summarizing the chapter before we get there, we'll talk about each class of assets in this chapter, and we'll talk about the systematic write-off, and we'll talk about the impairment. Those are the three primary issues, making sure you know what goes into each category, defining them, showing you how they're written off. And by the way, they're all the same. Straight line amortization is the same as straight line depreciation, is the same as straight line depletion. Doesn't change anything. And that's where you get the term you'll hear this a lot, DDA. Depreciation, depletion, amortization. Depreciation, depletion, and amortization. So that is an outline of where we're going to be going. Now we're going to start with, I guess, the tangible assets and intangibles, and say a little bit about natural resources. Natural resources are also known as wasting assets, I guess, as well. But the characteristics they have, aside from some of the specific characteristics, is that these are long-lived assets, and they will be generating revenue for extended periods of time. And also, they're acquired for their use in the production and sale of other assets. So their main characteristics are that they're long-lived and used in the generating of revenue or production and sale. Now the difference, of course, is in their individual characteristics. So let's look, we're going to start with the tangible and the intangibles. So tangible assets are long-lived, they have physical substance, they're used in production and sale of other assets, and they of course include land, buildings, machinery, fixtures, equipment, anything that's used in the business that is tangible in nature. Intangible assets have no physical substance, but they have economic value because of the rights that they confer on the holder. So if you buy a McDonald's franchise, you get a piece of paper that gives you the right to sell the product. So it is a right to use or the right to sell the product. And we also have patents, copyrights, and by the way, I'm not going to go through and ask you to memorize, how many years a copyright lasts. It's not going to be on the exam, 28 years, renewable indefinitely, or for the life of the author, or whatever it may be. I'm not going to even, that changes a lot. It's not something you need to know unless you're dealing with a specific. Just need to understand that copyrights, patents, trademarks, what goes into intangibles, the most important thing for us is going to be which of those intangibles are indefinite and goodwill, not subject to amortization, and which are definite or finite life intangibles that would be subject to amortization. Now, if we go a little further, we'll see that if we look at Walmart's balance sheet, they have their tangible plant assets into two categories. This could be in a footnote or on the face of the balance sheet. What I wanted to make sure you understand is that we're not going to, it is in this book, we're not going to cover this in intermediate, that we do have leases. So remember that a tangible asset is, or all assets are owned or controlled. You don't own leased assets, you control them. And they still go up with your plant and equipment. Now here's an interesting difference. You notice we've got accumulated depreciation, accumulated amortization. Why do you amortize a leased asset and depreciate a plant asset. So you have a fleet of trucks. I have exactly the same fleet of trucks. You bought yours, I lease mine. You call it depreciation, I call mine amortization. Why, if I lease mine? What's the difference?
Renting is just the right to use something.
That's the right, yeah, I don't own those assets, so we just differentiate that. Does it mean a lot in terms of the calculation? Absolutely not. It's exactly the same. You know, we're still going to depreciate and amortize these assets in the same way. And of course, you have to have leased equipment on your balance sheet because that, in fact, is going to contribute to generating your income. And don't forget, cost minus accumulated gives you the book value.